Ever faced that moment in a partnership, where you knew you wanted out, but suddenly got this cold feeling thinking about the
Oh,
taxes?
absolutely. It happens all the time.
Yeah, picture this. You've built something great, you're ready for the next thing, and then bam, you get hit with this massive, unexpected tax bill that just wipes out a huge chunk of what you thought you were getting.
It's a genuine fear and, frankly, a common nightmare if you're not prepared. But it absolutely doesn't have to be that way.
Okay, so that's exactly why we're diving deep today.
Precisely. We're aiming to cut through all that complexity, give you a kind of shortcut to really understanding the critical tax implications when you exit a partnership.
Right.
Our mission here really is simple. Arm you with the knowledge you need, help you make smarter financial decisions, proactively optimize things from a tax perspective.
And avoid those really costly surprises, whether you're the one stepping away, selling your piece, or maybe planning for retirement.
Exactly. It's about empowerment.
We've gathered, well, quite a stack of material here. It unpacks pretty much every angle of partnership exits. We're talking outright withdrawals, selling your interest, even what happens with retirement or, sadly, if a partner passes away.
And here's where it gets really valuable for you, the listener.
Yeah.
Mastering these details isn't just about, checking boxes for compliance. It's about unlocking potentially significant tax savings. It's about strategic financial control.
Okay, I like the sound of that. Let's unlock this. All right, so you've made the call. Time to step away from the partnership. Our sources lay out basically 3 main roads you can take to liquidate your interest.
Think of them as, different paths to the same goal, but each one has its own, let's say, tax landscape.
Okay, what are they?
First, there's a complete withdrawal. We often call that a liquidating distribution. Second, you could sell your partnership interest outright to someone else.
To another party, yeah.
Exactly. And third, there's exiting through more planned events like retirement or, unfortunately, through a partner's death.
Got it. 3 paths. So we're going to tackle each one.
We are. Let's start with what might seem the most straightforward, although, as we'll see, it definitely has its nuances. That's the complete withdrawal, the liquidating distribution.
Okay, complete withdrawal. That's the first thing we need to understand here.
What's truly fascinating from a tax perspective is how your original investment, what we call your basis in the partnership interest, becomes the absolute bedrock. It dictates everything tax-wise.
Basis. That word comes up a lot in tax talk.
It does. Imagine your basis as your sort of personal financial scorecard for your stake in that partnership. In a complete liquidation, the tax basis you get for any property distributed to you is directly tied to the adjusted basis of your partnership interest.
Okay, adjusted basis. So it's not just what I put in on day one.
Not at all. It's a dynamic number.
Yeah.
It constantly shifts. Think of it like a living ledger that tracks your whole history with the partnership financially.
A living ledger. I like that. So how is that adjusted basis actually figured out, especially right at this critical moment, right before you withdraw?
Great question. It has to be pinpointed immediately before the liquidation, like right then.
Okay.
And that means you have to account for every single financial movement that affected your stake right up to that moment. That includes your share of all the partnership income earned,
Right, the profits.
any losses you've been allocated over the years,
Okay.
and crucially, any changes in partnership liabilities that affect you. So maybe the partnership took on more debt you're responsible for, or maybe debt was paid off, relieving you.
So debt changes basis too.
Absolutely. All these things adjust your basis up or down. And that final precise number, calculated right before the distribution, is your starting point. It's the linchpin for figuring out the tax consequences.
Okay, makes sense. So you've got this precise adjusted basis number. When do you actually feel the tax impact? Like, when does a gain or loss actually hit your wallet? Does it happen right away, or does it depend on what kind of assets you get back?
That's a really critical distinction for tax planning. You recognize a gain, meaning you pay tax on it now, only if the money you receive, and we mean actual cash here.
Just cash.
Yes, specifically, cash exceeds your adjusted basis in the partnership interest. Think of it as your personal break-even point. If the actual cash you walk away with is more than your cost in the partnership, adjusted for everything we just talked about.
Earnings, losses, liabilities.
Right. If the cash exceeds that adjusted basis, that's when the IRS says, okay, that excess is a taxable capital gain right now.
Got it. Cash over basis equals immediate capital gain. Simple enough. What about the flip side? Losses. Can you recognize a loss immediately too, or is that more complicated? Does it depend on the assets?
You absolutely can recognize a loss immediately in a complete withdrawal, But, and this is a big but, it comes with a very specific set of
Oh,
conditions.
what are they?
You'll recognize a loss only if the only assets you receive are 1, money, or 2, specific types of hot assets.
Hot assets. We'll need to define those later, I assume.
We will. But for now, think things like unrealized receivables, basically money owed to the partnership for services that hasn't been taxed yet, usually for cash basis folks, or inventory.
Okay, so only cash, unrealized receivables, or inventory.
Correct. And the second condition is that your adjusted basis in the partnership interest must be more than the partnership's basis in those specific assets you received.
So if I get only those things and my basis is higher, I get a loss now.
Exactly. But if you receive any other kind of non-cash asset, think land, buildings, equipment, maybe marketable securities, anything other than those specific hot asset types, then the loss isn't recognized immediately. Instead, your remaining basis, your unrecovered cost, simply gets transferred over to those non-cash assets.
Ah, so the loss is sort of embedded in the basis of the property I received.
Precisely. It defers the tax consequence. You won't realize that loss for tax purposes until you eventually sell those assets you received.
That sounds like it could be useful. A deferral strategy.
It can be a very powerful strategy, yes. It gives you control over when you recognize the loss.
Okay. And the character of the gain or loss when it is recognized. Is it treated like my regular salary, ordinary income? Or is it something different, hopefully better?
Generally, it's treated as a capital gain or loss.
Okay. Capital. Why?
Because your partnership interest itself, your ownership stake, is considered a capital asset, much like owning a share of stock.
Right.
And this is a crucial distinction for tax purposes. Why? Because capital gains, especially long-term ones, usually get taxed at more favorable rates than ordinary income.
Lower rates. That's what we like to hear.
Exactly. So knowing whether your gain or loss is capital or ordinary can significantly impact your final tax bill, your cash flow after you exit. It's really fundamental to understanding your post-exit financial picture.
Okay, this is making sense conceptually, but let's put it into practice. I think seeing some numbers always helps cement these rules. Our sources gave us some great examples with a partner named Tag.
Yes, the tag examples are excellent for illustrating these core principles.
All right, first up, scenario 1. Tag gets cash and real estate. Here are the facts. Tag had a $24,000 adjusted basis in his KJT partnership interest. When he completely withdrew, he received $5,000 in cash. Plus, he got a piece of real estate. The real estate was worth $20,000 on the market, but the partnership's own adjusted basis in it was only $10,000.
Okay.
So 2 key questions here. How does Tag figure out his basis in that real estate he just got? And what are the immediate tax consequences? Does he owe tax now?
Good questions. So for Tag's basis in the real estate, it's a direct calculation.
Yeah.
You start with his partnership interest basis, which was $24,000.
Right.
Then you first subtract the cash he received. He got $5,000 cash.
Okay, so $24,000 minus $5,000 leaves $19,000.
Exactly. That $19,000 becomes his new basis in the real estate he received.
His basis is $19,000, even though the partnership's basis was $10,000 and the value is $20,000.
Correct. His basis is determined by his own remaining partnership interest basis after accounting for the cash.
Interesting. Okay, so what's the implication for his taxes right now?
This is really significant for his immediate tax situation. No gain or loss is recognized at the time of withdrawal. 0 immediate tax impact.
Why not?
2 reasons, based on the rules we just discussed. First, the $5,000 cash he received did not exceed his $24,000 partnership interest basis.
Okay, cash wasn't over basis. Check.
Second, and crucially, he received a non-cash asset, the real estate, that was not inventory or unrealized receivables. Because he received this other property, any potential loss is deferred, and since the cash didn't exceed basis, there's no gain.
So this is that non-taxable liquidation idea in action.
To the classic example.
Yeah.
What this means for you, the listener, is that the tax on any appreciation in that real estate, the difference between its value and its basis, is deferred. You don't pay tax on that potential gain now.
You pay it later if and when you sell the real estate.
Precisely. It can be a powerful deferral strategy, helping you manage cash flow right after you exit without an immediate tax hit.
Okay, that deferral makes sense. Very valuable. But what if the cash amount was much higher? Let's tweak the scenario. Scenario 2. More cash than basis. Same setup. Tag's basis is $24,000. But this time, what if he received $25,000 in cash plus that same piece of real estate? How does that change things?
Now things change dramatically.
Right.
This is where immediate gain recognition kicks right in. It's a stark contrast to the deferral we just saw.
How so?
If Tag receives $25,000 in cash, we do that simple comparison again. Compare the cash received to his adjusted basis.
Okay, $25,000 cash versus $24,000 basis.
Since the cash received, $25,000 exceeds his basis by $1,000.
He has a gain.
He recognizes an immediate $1,000 capital gain. That $1,000 is taxable in the year he receives it.
Okay, immediate tax hit. What happens to the real estate he also got? What's his basis in that?
Because all of his $24,000 basis was used up and even exceeded by the cash distribution, the real estate he received now has a zero basis to him.
Zero basis. Wow. So if he sells it later for $20,000.
The entire $20,000 would be taxable gain at that point.
Got it. So this really highlights a key planning point. Cash distributions over your basis trigger immediate tax. You need to be really careful about how much cash you take out in a liquidation.
Absolutely critical. Pre-exit planning around the mix of assets, especially cash, is vital to managing that immediate tax bill.
Okay. Now, what if Tag didn't get any property at all? Let's try scenario 3. Only cash, resulting in a loss. Basis is still $24,000, but this time he just gets $20,000 in cash. No real estate, no inventory, nothing else, just cash. Can he claim a loss now?
Yes, this is indeed a situation where a loss can be recognized immediately.
Because he only got cash.
Exactly. If Tag received only $20,000 cash and his partnership interest basis was $24,000, he recognizes a $4,000 loss right away.
How's that calculated?
It's straightforward.
E.
His $24,000 basis minus the $20,000 cash received equals a $4,000 loss. And that's recognized as a capital loss in that year.
Capital loss, okay.
The crucial element, as you noted, is that he received only cash. Remember our earlier rule. If he had received any other property in addition to the cash, that loss would typically be deferred and rolled into the basis of that property.
Right, like in the first scenario where his basis went into the real estate.
Precisely. So scenario 3 highlights how the specific type of assets you receive, or in this case, the lack of certain types of assets, determines whether a loss is immediately deductible or deferred. It really influences your tax strategy for the year you leave.
Okay, one last tag scenario. This one brings back those hot assets. Scenario 4, hot assets, resulting in a loss. Let's say Tag's basis is still $24,000. He gets $5,000 cash plus some property. But this time the property isn't real estate, it's unrealized receivables or inventory. Let's say the partnership's basis in this hot asset property was $10,000. Does he get a loss now?
This scenario really highlights the unique treatment of those hot assets, which, as you said, we'll definitely dig into more when we talk about sales. But for a liquidating distribution like this, yes, he would recognize a loss.
Even though he received property, not just cash.
Yes, because the type of property matters. If the property Tag received was specifically unrealized receivables or inventory, and his basis was $24,000, he would recognize a $9,000 loss.
Okay, how do we get to $9,000?
The calculation is, you take his $24,000 partnership interest basis, subtract the $5,000 cash received. That leaves $19,000. Then you subtract the partnership's basis in the hot assets distributed, which was $10,000.
$19,000 minus $10,000 is $9,000. That's the loss.
That's the immediate capital loss recognized. And Tag's basis in those unrealized receivables or inventory he received would be $10,000, the same as the partnership's basis in them.
So what's the key implication here?
It reinforces that specific loss recognition rule. Generally, losses are recognized only if you receive only money, unrealized receivables, or inventory. This example shows that receiving these specific types of non-cash assets, these hot assets, can trigger immediate loss recognition, unlike receiving other property like real estate.
So, for you listening, understanding the exact nature, the type of assets you're about to receive in a liquidation is absolutely paramount.
It really is. It determines your immediate tax outcome and ensures you capture any eligible losses in the year you leave the partnership. It's all about the details.
Okay, those tag examples really drove home how critical basis is and how the type of asset matters for immediate gain or loss. But, life is rarely that simple. What if you're not just getting cash? And one other thing, what if you walk away with a whole mix of stuff? Cash, maybe some inventory, some equipment, a piece of land. This feels like where things could get incredibly complicated fast.
You're right. It does add layers of complexity. And this raises a really important practical question. When you get multiple assets in a complete liquidation, how do you spread your remaining partnership basis, that outside basis, among all those different items?
Yeah, how does that allocation work?
There's a very specific set of rules. Think of it like this. Your partnership basis is a finite pool of cost. It needs to be perfectly allocated across everything you receive, ultimately zeroing out your interest.
Okay, a finite pool. Is there an order?
Yes, a strict order. The general rule is you assign basis first to any cash received. Then you assign basis to those hot assets, inventory and unrealized receivables, up to the partnership's basis in them.
Cash first, then hot assets.
Correct. And then whatever basis you have left over gets allocated to any other property you receive, like land, buildings, equipment, etc.
Okay, that sounds manageable. But what if I get, say, 2 pieces of land? Or different types of inventory? How do I split the basis within those categories?
That's where it gets more detail. If you have multiple assets within a single category, especially that last other property category, you have to follow a specific, quite intricate 3-step allocation process.
A 3-step process. Okay, let's unpack that. Our sources gave us 2 scenarios based on a key difference. Whether your personal basis in the partnership, your outside basis, is less than or more than the partnership's basis in the assets being distributed, the inside basis.
Exactly. And this difference is where it gets really interesting for your future tax picture. It determines whether your basis in the assets you walk away with gets reduced or increased.
Which can make a huge difference when you eventually sell those assets. This allocation process sounds like a critical piece of tax planning, maybe even a tax-saving method itself if you understand it.
It absolutely is. Understanding this can save you significant money down the line, or conversely cost you if it's not handled right. Let's look at illustrative scenario 1. Gertie's outside basis is less than inside basis. This shows what happens when your investment, your outside basis, is lower than the partnership's book value, its inside basis of the assets coming out.
Okay, Gertie's basis is low. What are the facts?
Gertie's adjusted basis in his partnership interest was $229,000. He received a liquidating distribution containing cash, $4,000, partnership basis and fair market value FMV were both $4,000, inventory, $10,000 partnership basis, but worth $15,000 FMV, landlord A, $200,000 partnership basis, but only worth $150,000 FMV, a lost property. Landlord B, $100,000 partnership basis, but worth $300,000 FMV, an appreciated property.
Okay, quite a mix. What are the totals?
The total partnership basis in all these assets adds up to $314,000. Their total fair market value is $469,000.
Right. And Gertie's basis is only $229,000.
Correct. So Gertie's $229,000 outside basis is significantly less than the partnership's $314,000 total inside basis in those assets. This immediately tells us something important.
What's that?
It means Gertie's basis in the property he receives will have to be reduced, effectively stepped down. We have to shrink the basis of the assets in his hands so that the total allocated basis equals his $229,000 starting point, perfectly zeroing out his partnership interest.
A step down, so he'll have more potential gain if he sells those assets later.
Potentially, yes. A lower basis generally means higher future gains. Let's see how that step down happens using the 3-step process in detail. Remember, the goal is to allocate exactly $229,000. Step 1. First, we tentatively assign basis to all distributed assets equal to the partnership's basis in them. So cash gets $4K, inventory gets $10, lot A gets $200K, and lot B gets $100K.
That adds up to the $314,000 partnership basis we mentioned.
Correct. Now, compare that $314,000 to Gertie's actual partnership basis of $229,000. We see we have assigned $85,000 too much basis. $314,000, $229,000.
So we need to reduce the basis assigned to the assets by $85,000.
Precisely. We have an $85,000 required decrease. Step 2. Now, we focus only on assets in the last property category distributed. Here, that's the other property category, which contains landlord A and landlord B. Within this category, we look for any assets that have decreased in value where FMV is less than the partnership's basis.
That would be lot A. Its basis was $200, but its FMV is only $150K.
Right. It is built-in depreciation of $50,000. Step 2 tells us to reduce the basis of such assets, but only down to their FMV. So we reduce Lot A's basis by that $50,000 difference.
Okay, so Lot A's tentative basis drops from $200K to $150K.
Correct. And this $50,000 reduction helps us eat into that $85,000 total reduction we needed. We've now accounted for $50K of it, leaving $35,000 of reduction still to be allocated. $85,000, $50,000.
Okay, $35,000 still needs to be cut from somewhere.
Step 3. This remaining required decrease, the $35,000 is now allocated among all assets in that last property category, Lot A and Lot B. But how? It's based on their relative adjusted basis at this point, after Step 2 adjustments.
So Lot A's basis is now $150K after the Step 2 reduction. Lot B's basis is still $100 and didn't decrease in value.
Right. The total adjusted basis in this land category is now $250,000, 150K plus $100. We allocate the $35,000 reduction proportionally.
Okay, proportionally. How does that math work?
For Lot A, the reduction is $35,000 times $150,000 divided by $250,000. That fraction is 0.6 or 60%. So $35,000.6 equals $21,000 reduction for Lot A.
Okay, $21,000 reduction for Lot A.
For Lot B, the reduction is $35,000 times $100,000 divided by $250,000. That fraction is 0.4 or 40%. So $35,000 0.4 equals $14,000 reduction for Lot B.
Got it. $14,000 reduction for Lot B. Now we apply these reductions.
Yes. Lot A started step 3 at 150K, minus 21K leaves 129K. Lot B started step 3 at 100K minus 14K leaves 86K.
So let's recap Gardy's final basis and everything he received.
His final basis is cash $4,000, always face value. Inventory $10,000 takes partnership basis. Land Lot A $129,000, land Lot B $86,000.
And if we add those up, 4K plus 10K plus 129K plus 86K, that equals $229,000, exactly his original partnership basis.
Perfectly zeroed out. That's
Wow.
the goal. The implication here is crystal clear. Gardy's basis in the land has been significantly reduced from the partnership's original basis. This step-down process directly impacts his future tax liability if he sells that land. A lower basis means a higher taxable gain later.
It really ensures his lower initial investment is reflected in the assets he now holds.
Precisely. It prevents him from getting the benefit of the partnership's higher inside basis when his own investment was lower. Understanding this step-down is crucial for long-term tax forecasting after you leave.
Wow. Okay, that's quite a process for the step down. It makes sense, ensuring the basis matches. But what about the flip side? You said it gets really interesting if your outside basis is more than the partnership's inside basis. Does the three-step process work in reverse? Do you get a beneficial step up? This sounds like where the real tax optimization opportunity might lie.
It absolutely does. This is indeed where you can see a significant tax advantage, a real aha moment for someone exiting with a high basis. Let's look at illustrative scenario 2. Gardy's outside basis is more than inside basis.
Okay, same assets distributed.
Exactly the same assets as before. Cash $40, inventory $10, Lot A, basis $200K, FMV $150K, Lot B, basis $100K, FMV $300K. The total partnership inside basis is still $314,000.
But this time, Gardy's basis is different.
Yes. This time, Gardy's adjusted basis in his partnership interest is a much higher $529,000.
Okay, $529,000 outside basis compared to $314,000 inside basis. He's got way more basis than the asset's book value.
Exactly. And this is fantastic news for Gardy from a tax perspective. It means his basis in the property he receives will be increased, effectively stepped up. We need to allocate that extra basis to the assets to fully absorb his higher partnership interest basis.
A step up. That means lower future gains if he sells.
Correct. This step up is a crucial tax-saving opportunity because it directly reduces future taxable gains when those assets are eventually sold. Let's walk through the three-step process again, but this time aiming to allocate that extra basis. Step 1. Same starting point. Tentatively assigned basis equal to the partnership's basis. Cash $4K, inventory $10, Lot A $200K, Lot B $100K, total assigned $314,000.
But Gardy's basis is $529,000.
Right. So this time when we compare the $314,000 assigned basis to his $529,000 outside basis, we have a positive remaining balance of $215,000. $529,314,000.
So we need to increase the basis of the distributed assets by $215,000.
Exactly. We have a $215,000 required increase. Step 2. Now, this step works differently for increases. We again focus on the last property category, the land. But this time, we look for assets that have appreciated in value, where FMV is higher than partnership basis. We can increase the basis of these assets, but only up to their fair market value.
Okay, which land appreciated? Lot B. Its basis was $100K, but its FMV is $300.
Right. Lot B has built-in appreciation of $200,000. Step 2 allows us to increase Lot B's basis by this $200,000 difference, bringing its tentative basis up from $100 to its $300K FMV.
Okay, Lot B's basis jumps to $300.
And this $200,000 increase uses up a big chunk of our required $215,000 total increase.
Yeah.
We now only have $15,000 in increase left to allocate.
Yeah.
$215,000, $200,000.
Right, $15,000 still needs to find a home. What about Lot A? It decreased in value. Does its basis change in step 2 here?
No. Step 2 only adjusts appreciated assets upwards in this increase scenario. Lot A's basis remains at its initial $200,000 for now. Step 3. Finally, we allocate the remaining basis increase that $15,000 positive balance among all assets in that last property category. Lot A and Lot B. And here's a key difference from the decrease scenario. This final allocation is based on their relative fair market values, FMV, not their adjusted basis.
Ah, FMV for the final step-up allocation. Okay. Lot A's FMV is 150K. Lot B's FMV is 300K.
Correct. The total FMV for the land category is $450,000, 150K plus 300K.
Yeah.
We allocate the $15,000 increase proportionally based on these FMVs.
Okay, the math.
For Lot A. The increase is $15,000 times the $150,000 divided by $450,000. That fraction is 13. So $15,000, 13 is $5,000 increase for Lot A.
Okay, $5,000 increase for Lot A.
For Lot B. The increase is $15,000 times $300,000 divided by $450,000. That fraction is 23. So $15,000, 23, or $10,000 increase for Lot B.
Got it. $10,000 increase for Lot B. Now apply these.
Yes. Lot A started step 3 at 200K plus 5K makes 205K. Lot B started step 3 at 300K after the step 2 bump plus $10 makes 310K.
All right, let's sum up Gertie's final basis this time.
Final basis. Cash, $4,000. Inventory, $10,000. Land Lot A, $205,000. Land Lot B, $310,000.
Adding those. 4K plus $10 plus $205K plus $310. Yes, that's $529,000. His entire high basis is accounted for.
Exactly. The implication here is genuinely powerful for tax optimization. Gertie gets a significant step up in basis for both pieces of land compared to the partnership's original basis.
Which means lower taxable gain, or maybe even a bigger loss if he sells them later.
Precisely. This highlights how understanding these rules can be a powerful tax-saving method. By properly allocating your higher outside basis, you effectively reduce your future tax liabilities. You ensure you don't pay tax on value that you essentially already paid for through your higher original investment or share of accumulated profits that increased your basis.
It's a key strategy for preserving wealth when you exit. That step up is gold.
It really can be. It's a fundamental mechanism for aligning the tax consequences with the partner's actual economic position. And just one final but quite important point on these complete withdrawals. The partnership entity itself. It doesn't recognize any gain or loss when it distributes these assets.
Oh, interesting. So it's all at the partner level?
Entirely.
Ah.
Partnerships are flow-through entities. That means all the tax effects of winding up and liquidating, including any gains or losses the partnership might realize on selling assets to get cash before the distribution, or any expenses of liquidation, flow through and adjust the partner's basis immediately before they receive their liquidating distributions.
So it all gets baked into that final adjusted basis number we use for the partner's calculation.
Exactly. It ensures all tax consequences land squarely on the individual partner's shoulders, simplifying the partnership's final tax accounting and centralizing the tax impact where it belongs with the exiting partner.
Okay, so we've really gone deep into complete withdrawals, the basis stance, the step up, the step down. But what if you're not doing a liquidating distribution from the partnership itself? What if you just sell your partnership interest outright to someone else? Maybe an existing partner, maybe a totally new person. Does that make the tax calculation simpler, or does it introduce its own set of challenges?
That's the second major path, selling your interest. And yes, it has its own distinct set of rules. As a general starting point, when you sell or exchange your interest in a partnership, the gain or loss you recognize is typically capital gain or loss.
Capital gain or loss again. Why?
Same reason as before, fundamentally. Your partnership interest itself, your ownership slice, is considered a capital asset, like stock. So selling that capital asset generally results in a capital gain or loss. That's the default rule.
Okay, capital asset treatment. And how do you figure out the amount of that gain or loss? Is it just the cash price they pay you minus your basis? You mentioned earlier there might be more to it.
You're right to be cautious there. It's definitely not just about the cash received. Your recognized gain or loss is the difference between the amount realized from the sale and your adjusted basis in the partnership interest right before the sale.
Amount realized. Okay, what goes into that?
It includes the cash, obviously,
Yep.
and any property you receive. But here's the crucial detail that often trips people up and can significantly inflate the gain if missed. Any partnership liabilities allocated to your interest that the buyer effectively takes over are also included in your amount realized.
So if the buyer assumes my share of the partnership's debt,
That debt relief is treated as additional cash you received. Think about it. If someone takes over your $5,000 share of debt, it's economically the same as if they handed you an extra $5,000. The IRS sees it that way for tax purposes.
okay, that makes sense, but could be easily overlooked. Let's use that example from the sources, Christy, to make it concrete. This liability point seems vital.
Yes, the Christie example is perfect for this.
All right, illustrative scenario. Calculating amount realized with Christy. The facts. Christie sold her interest in the KJT partnership to a new partner, John. John paid her $15,000 in cash, but John also agreed to assume Christie's $5,000 share of the partnership's liabilities.
Okay, so for the analysis, what is Christie's amount realized? It's not just the $15,000 cash.
Right, it has to include the debt relief.
Exactly. It's the $15,000 cash plus a $5,000 relief from partnership liabilities. Her total amount realized is $20,000.
And that $20,000 is what she compares against her adjusted basis to figure out her gain or loss.
Precisely. The implication here is huge for accurate tax planning. If Christie forgot about that $5,000 liability relief and only reported $15,000 as her amount realized, she'd be understating her gain significantly.
Leading to potential penalties and interest down the road when it gets caught.
Exactly. So, for anyone listening who is contemplating selling a partnership interest, understanding that assumed liabilities increase your amount realized is absolutely fundamental. Get that number wrong, and your whole tax calculation is off. It can save you a major financial headache later.
Okay, so the general rule is capital gain or loss, calculated using cash plus liability relief minus basis. But you hinted earlier there was an exception. Something about hot assets. Does that apply to sales too?
It absolutely does, and it's arguably even more critical in a sales scenario. While the default is capital gain, there's a significant exception that can recharacterize part of that gain, sometimes a large part, into higher taxed ordinary income.
Ordinary income instead of capital gain. That's usually not good news tax-wise.
Generally not, no. This is the hot asset trap we mentioned. It's critical to understand this for managing your tax bill effectively when selling an interest.
Okay, explain this trap. Why does part of the gain get treated as ordinary income? What are these hot assets in the context of a sale?
Any portion of your gain that is attributable to your share of the partnership's hot assets is treated as ordinary income, not capital gain.
Why the ever treatment?
The logic is pretty straightforward from a tax policy view. If the partnership itself sold those specific hot assets directly, the gain would be ordinary income, like selling inventory. The rule prevents you from converting what should be ordinary income into lower tax capital gain simply by wrapping it in a partnership interest and selling the interest instead.
It's an anti-abuse rule. Stops you from changing the character of the income through the form of the transaction.
Exactly. It ensures tax treatment consistency.
Hmm.
Now, what are details on hot assets, specifically for a sale of a partnership interest? They include two main things we saw before: inventory and unrealized receivables.
Right. Inventory held for sale and fees earned but not yet collected for cash basis folks.
Yes. But for sales, there's a crucial third component that's often the biggest piece: potential depreciation recapture on the partnership's depreciable assets, like buildings or equipment.
Depreciation recapture. How does that work here?
When you sell your interest, you have to calculate how much depreciation recapture would be recognized if the partnership had sold all its depreciable assets at their current fair market value right at that moment. Your share of that hypothetical recapture is treated as an unrealized receivable, a hot asset for the purpose of your sale calculation.
Wow. So even if the partnership isn't actually selling the asset, the potential recapture built into it taints part of my sale gain.
Precisely. It taints it and converts that portion of your capital gain into ordinary income.
What's the implication of this trap for someone selling?
The implication is profound. If your partnership holds significant hot assets, especially if it has heavily depreciated property with a low basis compared to its market value, a potentially large chunk of your gain on selling your interest could be taxed at your higher ordinary income tax rates, not the lower capital gains rates you might have been expecting.
That could be a nasty shock.
It certainly can be. This is why knowing this before you finalize the sale is not just important, it's absolutely vital for planning. Understanding your potential ordinary income exposure might lead you to negotiate a higher sale price to cover the extra tax, or perhaps explore other strategies, though they have their own complexities.
Like maybe having the partnership sell some assets first.
That's sometimes considered, but it needs careful analysis. The bottom line is you need thorough due diligence and likely expert tax advice before selling to understand and proactively manage this potential ordinary income hit. It's all about proactive tax optimization, not reactive shock.
Makes sense. Okay, beyond the gain calculation and the hot asset trap, there's one more practical thing when selling mid-year. How do you handle the partnership's income or loss for the year you sell? Does the seller get it all up to the sale date? Does the buyer get it all from that point on? How's it split?
That's another excellent practical question, and the tax code handles it with a principle of fairness, usually through proration. when a partner sells their entire interest during a tax year. Their share of the partnership's income, gains, losses, deductions, credits, everything on the K-1, must generally be allocated pro rata between the selling partner and the buying partner,
Pro rata based on what?
based on the portion of the year each person was actually a partner. Usually this is done based on the number of days each held the interest.
Okay, number of days. So it's precise.
Yes, the idea is to prevent the seller from being taxed on income earned after they left or the buyer being taxed on income earned before they joined. It ensures precise attribution based on the ownership period. Sometimes partnerships can use an interim closing of the books method too, but daily proration is common.
Let's use that example from the sources to see the proration in action. Illustrative scenario. Proration of partnership income.
Okay.
The facts. Partner A owns a 20% interest. She sells her entire interest to new partner B on March 31st. Let's assume it's not a leap year, so 365 days. The partnership reported $80,000 of income for the full calendar year. How is that $80,000 split between A and B for tax purposes?
Okay, first we figure out the days. Partner A held the interest from January 1st to March 31st. That's 90 days.
90 days for A.
New partner B holds it from April 1st to December 31st. That's the remaining 275 days. 365, 90.
Okay, 275 days for B.
Now we calculate each partner's share of the total $80,000 income. Partner A's share is $80,000 total income times 20% her interest times her portion of the year, 90, 365 days.
Okay, $80,000, 20 cents, I-50, 65.
Which comes out to approximately $3,945. That's the income allocated to partner A on her final K-1.
Got it. And partner B?
Partner B's share is $80,000 total income times 20% her interest times her portion of the year, 275, 365 days.
$80,000, 20 cents, 27.5, 365.
Which is approximately $12,055. That's the income allocated to partner B on her K-1 for that year.
And $3,945 plus $12,055 equals the $16,000 total share, 20% of 80K. So that works out.
Exactly. The implication is clear. This proration ensures the partnership income is properly attributed to each partner based on their actual time in the partnership during the year of sale. It's an administrative but absolutely crucial step for accurate tax reporting for both the buyer and the seller. Get this wrong, and someone's paying the wrong amount of tax.
All right, we've covered complete withdrawals with all the basis intricacies, and we've covered outright sales with the amount realized calculation and that tricky hot asset rule. What about the third category of exits, the more planned transitions, things like a partner retiring or, in the unfortunate event, a partner passing away? Are there special rules for payments made in those situations?
Yes, there are specific rules that govern payments made by the partnership to a retiring partner or to the successor in interest of a deceased partner when those payments are made to liquidate their entire partnership interest. These rules allocate the payments into different categories, and that allocation has very direct and distinct tax consequences.
Different from a simple sale to a third party.
Often, yes, particularly in how the payments might be characterized. It's vital for long-term financial planning for the person leaving or their estate.
Okay, so what's the key distinction we need to grasp here? How are these liquidation payments for retirement or death treated differently?
The fundamental distinction hinges on what the payment is for. Payments made in exchange for the partner's interest in specific partnership assets are generally treated like a sale or exchange.
Meaning capital gain or loss, potentially subject to hot asset rules.
Generally, yes. You're essentially being bought out of your share of the business's property, so it follows similar capital transaction principles. However, if the payments are determined based on partnership income.
What do you mean based on income? Like a percentage of future profits?
Exactly.
Yeah.
For example, if a retiring partner is set to receive, say, 10% of the partnership's net income for the next 5 years as part of their liquidation payout, those payments, because they are measured by future income, are treated differently.
How so?
They are treated as a distributive share of partnership income, if based on income, or as a guaranteed payment, if determined without regard to income. In either case, they are generally taxable as ordinary income to the retiring partner or their successor.
Ordinary income again. So they're treated almost as if they were still a partner receiving their share.
In essence, yes. They'd continue to receive a K-1 reporting this ordinary income. This is a major difference from just getting a lump sum for assets, which would likely be mostly capital gain.
What's the implication of this distinction? It sounds huge for tax planning.
It's profound. Receiving payments classified as ordinary income can significantly impact the recipient's tax bracket, potentially pushing them much higher than if they received the same amount as capital gain, given the preferential rates capital gains often enjoy.
So how these retirement or death liquidation payments are structured in the partnership agreement or the buyout agreement is critical.
Absolutely critical. Whether payments are explicitly for assets versus being tied to future income can be a major negotiation point. It's a powerful lever for tax optimization or tax traps for both the partnership, which might get a deduction for guaranteed payments, and the exiting partner or their estate. Proactive planning before these agreements are finalized is paramount to achieve the desired tax outcome.
This discussion about different treatments naturally leads us to something that sounds quite advanced, but potentially incredibly powerful, especially for incoming partners or in situations where basis doesn't match value. You mentioned the Section 754 election and the Section 743B basis adjustment. This sounds like it could be a game changer, a real aha moment for optimizing taxes and partnership transfers.
You've absolutely hit on a cornerstone of sophisticated partnership tax planning. The Section 754 election and the resulting 743B adjustment are critical mechanisms for preventing unfair tax burdens, particularly for new partners buying into a partnership where the assets have appreciated significantly since the partnership acquired them.
Okay, so what exactly is this Section 754 election? When is it made?
A partnership chooses whether or not to make a Section 754 election. It's optional, but once made, it's generally binding for future years, unless the IRS permits revocation. The election typically comes into play when there's a transfer of a partnership interest, either through a sale or exchange or upon the death of a partner.
And why would a partnership make this election? What problem does it solve?
It solves the potential mismatch between the new partner's outside basis, what they paid for their interest or the stepped-up basis at death, and their share of the partnership's inside basis, the partnership's historical cost basis and its underlying assets. Without this election, a new partner might buy in for $500K, but their share of the partnership's basis in its assets might only be $300.
Meaning, if the partnership then sells those assets,
The new partner could get allocated taxable gain that existed before they even joined. They'd be paying tax on appreciation they didn't benefit from, which is clearly unfair. The 754 election prevents this.
okay, so the 754 election opens the door. What's the Section 743B adjustment then?
When a Section 754 election is in effect and a transfer occurs, sale or death, the Section 743B basis adjustment is calculated. This adjustment amount is simply the difference between the new partner's outside basis and their share of the partnership's inside basis in the assets.
So in my example, $500K outside basis minus $300K share of inside basis equals a $200K adjustment.
Exactly. A positive $200,000 adjustment in that case. This adjustment amount is then allocated among the partnership's various assets according to complex rules under Section 755, but the key is its effect.
What is the ultimate goal or effect of this 743B adjustment?
The fundamental goal is to make the new partner's share of the inside basis of the partnership's assets equal to their outside basis. It essentially gives the new partner a personal step up or step down if their outside basis is lower in the basis of the partnership's assets, but only for their own tax calculation.
Just for them. It doesn't affect the other partners.
Correct. This is absolutely critical. The 743B adjustment is specially allocated only to the transferee partner. It has zero impact on the partnership's overall income or loss calculations or the K-1s of the other partners. It's a personal adjustment that aligns their tax consequences with their investment.
That sounds incredibly fair and logical. Does it always require an election?
Usually, yes, the partnership needs the 754 election in place. However, there's a mandatory adjustment rule. Even without a 754 election, the IRS requires a downward 743B adjustment if a new partner acquires an interest, and there's a substantial built-in loss at that time.
Meaning the inside basis is much higher than the outside basis.
Yes, specifically if the partnership's inside basis in its assets exceeds the fair market value of those assets by more than $250,000, or if the transfer partner would be allocated a loss of more than $250,000 if the assets were sold immediately. This mandatory downward adjustment prevents trafficking and losses.
Okay, so the rule works both ways to ensure fairness, preventing double taxation on gains and preventing artificial loss creation. Let's see it in action. An example would really solidify how powerful this 743B adjustment is, especially the step-up part for saving taxes.
Definitely. The Oscar example from our sources illustrates this perfectly.
Okay, illustrative scenario. Transfer of partnership interest with Oscar. The facts. Oscar buys Bernice's 25% interest in Hanley Partnership. He pays $500,000 for it. Crucially, Hanley Partnership has a Section 754 election in effect. Right before Oscar buys in, the partnership's main asset is a building with an inside basis of $1,200,000 and a fair market value of $2 million.
Okay, perfect setup. Let's walk through the analysis. First, what's Oscar's outside basis? It's his purchase price, $500,000.
Simple enough, 500K is his investment.
Next, what's Oscar's 25% share of the partnership's inside basis in that building? The building's total inside basis is $1,200,000. Oscar's share is 25% of that.
25% of $1.2 million is $300,000.
Correct. So Oscar's outside basis, $500, is higher than his share of the inside basis, $300K. Now, we calculate the Section 743B basis adjustment. It's the difference. $500,000 outside minus $300,000 inside share.
That's a positive adjustment of $200,000.
Exactly, a $200,000 step-up adjustment. This $200,000 adjustment belongs entirely to Oscar for tax purposes. It doesn't change the partnership's main books, but it creates a special personal layer of basis for Oscar attached to that building.
Okay, he's got this extra $200K basis just for him. Now, what's the crucial implication? Let's say down the road, the partnership sells that building for its fair market value of $2 million. How does the gain get allocated, especially to Oscar?
This is where the magic of the 743B adjustment happens. Let's look at the sale for $2 million. The total economic gain is $800,000. $2 million sale price minus $1 met original partnership basis.
Right, $800K overall gain.
Now, how is it taxed? For the other partners, their share of the gain is calculated based on the partnership's original $1.2 million basis. They will be allocated their proportionate share of that $800K gain.
Okay, they pay tax based on the old basis. What about Oscar?
For Oscar, his tax calculation uses his share of the original inside basis plus his special 743B adjustment. His share of the inside basis was $300,000. His 743B adjustment was $200,000.
So his effective basis for tax purposes is $500,000, $300K plus $200K.
Precisely. Now, what's Oscar's share of the $2 million selling price? He owns 25%, so his share is $500,000.
Wait, his share of the selling price, $500, exactly equals his effective tax basis, $500K.
You got it. The difference is zero. Because of that 723B adjustment, no gain is allocated to Oscar from the sale of the building.
Wow. The entire $800,000 taxable gain gets allocated only to the other partners.
That's correct. This is a massive tax benefit for Oscar. It ensures he isn't taxed on the $200,000 appreciation that happened before he bought his interest. He only pays tax on appreciation occurring after he joined.
That is incredibly powerful. It makes buying into an appreciated partnership so much more equitable from a tax standpoint.
It's truly a cornerstone of advanced partnership tax planning. It aligns tax consequences with economics and shields new partners from inheriting the tax liabilities of built-in gains. Without it, buying into partnerships with appreciated assets could be prohibitively expensive tax-wise.
Okay, wow. We have covered a ton of ground today. We really took a deep dive into the, let's face it, often very complex tax world of partnership exits.
We certainly did. From those liquidating distributions where your basis is king, dictating gain, loss, or deferral.
Yeah, and that whole meticulous three-step allocation process for multiple assets, figuring out step-ups or step-downs.
Right. Then shifting to selling your interests, understanding the full amount realized, including debt relief, and watching out for that hot asset trap that can convert capital gain to ordinary income.
And finally, looking at retirement and death payments and that incredibly powerful Section 754 election with the 743B adjustment, which can completely change the tax picture for an incoming partner.
It really covers the main pathways and some of the biggest tax considerations partners face when an exit occurs.
It really underscores that these rules, while complex, are manageable if you understand them.
Absolutely. And this brings up a really important question, I think. Knowledge is one thing, but applying it is where the value lies. Understanding these rules isn't just about ticking boxes for the IRS.
It's about strategy.
Exactly. It's about strategic planning. It's about proactive wealth preservation. Whether you're thinking about forming a partnership, buying into one, or planning your own exit down the road, knowing these intricate tax consequences is crucial.
It lets you structure deals better, negotiate terms more effectively,
and ultimately just make more informed financial decisions. It really is a shortcut, in a way, to managing your tax outcomes effectively and avoiding those really nasty, costly surprises.
That foreknowledge gives you a significant advantage. You can optimize things rather than just reacting.
Precisely. You can keep more of what you've worked hard to earn.
So, thinking about all these rules, the potential pitfalls, but also the opportunities, like the basis step up. What stands out to you? As a final thought for our listeners to chew on, Given these complexities, what kind of innovative strategies might partners think about before an exit even looms on the horizon? Not just to comply, but to genuinely optimize the outcome for everyone involved.
That's a great question to ponder. Is it about how the initial partnership agreement is drafted? Maybe regarding how different types of assets are held or how exit payments are defined? Could it involve planning asset distributions versus sales well in advance?
Or maybe carefully managing the partnership's debt levels leading up to potential exits. Lots to think about there. How can you proactively shape the tax landscape before you even step onto one of those exit paths? Something to definitely mull over until our next deep dive.